You're watching All About Money on HKIBC. I'm Isabel Wong. Well, this week, Hong Kong Chief Executive Carrie delivered the annual policy address and warned of, and quote, unprecedented economic challenge as Hong Kong's economy entered a technical recession in the third quarter. Lam also said she believes the city will be able to ride out what she describes as the storm and eventually move on. Meanwhile, the US House of Representatives passed 4 pieces of legislation in support of the ongoing protests in Hong Kong. But the chief executive warned the US Congress that any move that hurts Hong Kong will have an impact on Americans too.
The same frustration and disappointment and regret exists in either the Hong Kong SAR government or the Central People's Government, because this Hong Kong Human Rights and Democracy Act is totally unjustified and unwarranted. It will hurt not only the Hong Kong business, it will hurt American interests in Hong Kong. They have 1,400 companies, 85,000 citizens in Hong Kong who have taken Hong Kong as a home. So to have that sort of act creating a lot of uncertainties will also damage the business confidence and in turn the business's prospects in Hong Kong.
Just how harsh and complicated is the storm hitting Hong Kong right now? And can anything be done to turn things around? Let's bring in Carrie, Natixis Economist for Asia Pacific. Carrie, welcome back to the show. Well, this week we saw a lot of things happening in Hong Kong, especially the annual policy address. But some criticisms, they are saying that Carrie Lam's new policy address cannot really go to solve the housing pressure in the city, but it's more like a measure that will ensure housing prices in Hong Kong will not fall significantly. So what's your view on this? Does it really go to solve any sort of economic issues in the city right now?
Well, I think indeed if we look at the policy address that was published, it was actually indeed a special one because it's probably one of the shortest one that actually since the handover of Hong Kong back to China. So I think one of the focus here, especially from Carrie Lam, is really on land and housing, of which we actually see that there's a lack of substances of other key issues. For example, if we look at economic growth, healthcare, especially with actually worsening demographic situation in Hong Kong right now. So if we only look at the land and housing that she proposed, I think there's a few key points that we can look into. First, in terms of the supply of housing, there's really nothing really new, but really to reinforce, or there's a higher target for different type of housing. You have the green form, right form of like the sales of public or like subsidized public housing to different people, and there's also a higher number of the, I would say, the transitional housing as well. But however, if you really need to achieve all this target, one of the key that she needs is really to increase the land supply, of which the government has repeatedly mentioned it in numerous time of the policy addresses in the past. But I think this year there is indeed something new, especially if we think about the land resumption audience, and also there are different ways that she's trying to gather the partnership between the the public and the private in terms of like acquiring land. But however, there's one more point that she did is really to reduce the stress test requirement, that people can actually get a higher leverage at the cost of actually paying higher interest rate, or I would say a funding cost due to the insurance scheme. So I think the net effect of all of this is really that if we look at the issue of the land supply, if it really can be carried out, of which in the past it has been quite difficult, it should be able to lower the the home price, especially if we compare to some of the one of the closest example is probably Singapore. Over, let's say, since 2010, that if we look at the difference between population growth and also the the supply of residential unit growth, is that Singapore has seen a massive supply versus the population growth, versus the same case we cannot really see in Hong Kong. So for the land bit, we need to see a real increase and real commitment by the government to actually increase this land supply, of which is still lacking in the policy address. It seems to me it's only a direction that we need to continue and see whether the government will actually be able to do that. But however, for the leverage part, we think that that might actually help the home price in the short run, rather than really lowering the home home price and affordability, because I think after the policy address was released, when a lot of owner actually saw that. Saw that policy. They already, let's say, they stopped the sales of the property. They did adjust the price. Of course, whether what they think and what people really increase the leverage and buy, are two different questions. But at least what we see in the market is that there seems to be an adjustment of price, at least to stabilize it rather than lowering it.
While the policy address might not be necessarily good news to most of the Hong Kong citizens, another thing that some Hong Kong citizens would see as a good news is obviously the US House passing some of the bills in support of the Hong Kong democracy movement. So while the Chinese Foreign Ministry, they obviously issued a warning that they would retaliate if the US really goes to, say, pass the bills. Some are arguing that, passing these bills will help Hong Kong send a message to, say, foreign firms in Europe, in the States, anywhere outside China and Hong Kong, that Hong Kong is the city that is still safe for them to conduct financial transactions, it's still safe to trade. So what's your view on this? Because after all, what makes Hong Kong special is its special trading status with the US. What are some of the pros and cons the bill would have if they passed?
I think some of the good things that we can think of if the bill got passed, of which now there's still two different stages that, it needs to be go through one more step in the Congress and then need to be signed by US President Donald Trump. So I think the good thing that we can really think of is that first, it is actually not as aggressive as actually you revoking the whole, the Hong Kong Policy Act. This seems to be is an additional, I would say, framework or additional line that the US is trying to maintain its interests of the US, or maybe even further for the rest of other foreign investors that the US wants to influence and keep the interest, or at least keep the current status in Hong Kong right now. So I think for that, if that is successful, that should be positive, for a lot of foreign investors in terms of, let's say, the confidence of what they think about Hong Kong and then or the risk that they think about Hong Kong. But however, if we look at the coins, it's really that, if it is not successful or if there is any escalation of geopolitics or geopolitical issue between the US and China, whether this too will be used to further, constrain the ability of Hong Kong, especially in terms of financing or even Hong Kong citizens in terms of traveling visa requirement, or I would say the daily life. So this seems to be a double-edged sword. On the one hand, that it can help on reassuring some part of the confidence, but on the other hand, this could also bring some risk if the condition got escalated to further level. And of course, at the end of the day, it still depends on how this act will be used, because it could be passed and then it is only put on the shelf, but on the other hand, it could also be really used. But I think for now, we think that even if it got passed at the end, if it is got used, it's mostly targeting, I would say, individual companies or maybe even individuals, as in what the US has been doing in terms of different sanctions. So I don't think it will lead to a change in the status of what the US think about Hong Kong right now, which I think it is positive for Hong Kong, at least for now.
Yeah, that brings me to ask you about, capital outflow activity out of Hong Kong, because last time you were here, you were describing that capital outflow activity is still quite mild in the city, but then has the level of capital flight really changed after, say, the government enacted the emergency ordinance to, say, ban face masks during protests?
I think right now, from what we have seen, that if we look at the stock market or real estate price, it did fall a bit. Not only after the the emergency ordinance got passed, but actually all the way if we go back from June. So I think for now we haven't seen a really massive capital outflows or the sign of capital outflows, put it this way, because it's very quite difficult to actually measure the exact scale of capital outflows with very high frequency data. But we can look at different indicators to actually see that whether the stress has continued to build up. So from what we have seen is that I mean, a lot of structural difference or the issue seems to be here, but we haven't seen really huge sign of capital outflows, especially right after the emergency audience got passed. For example, if we look at some high frequency data, we see that like the HKD still haven't reached 7.85, which is the weaker convertibility, and also the I mean the aggregate balance is still quite flat. So I mean to that end, we haven't really seen a very strong push of the capital outflows away from Hong Kong. But however, if we take a step back, we did see I mean a slower growth in the HKD deposit, I mean year over year, and if we look at month over month, there is indeed a bit of fall, I mean up to August. And if we look further into I mean different sentiment, we continue to see that there's increasingly interest in acquiring overseas properties or like people trying to divest their assets elsewhere. So I think even though we still haven't seen all of this in the I mean statistical terms, but still we can conclude that yes, there is a change in asset, actually downward pressure in the asset prices, and I mean there is indeed some capital outflows, but it hasn't built up to the extent that is very huge. But
welcome back to All About Money. After Washington agreed to hold off on a planned tariff increase on Chinese imports last week, U.S. Treasury Secretary Steven Mnuchin said there's a workable first phase agreement with China, while both sides will hammer out details before their leaders meet at the APAC summit in Chile next month.
There's execution work to be done on the document, but this document is substantially done. We made a lot of progress, and our expectation is this will be concluded and signed by Chile. The current plan is there'll be deputy level calls this week. There'll be principal level calls next week with Ambassador Lighthizer and myself and the Vice Premier. Those are the things that are planned. I wouldn't be surprised if there's deputy level meetings in person. I think our expectation is we'll meet with the Vice Premier in Chile before the presidents meet to make sure there are any final issues.
But that was not enough to give the Chinese economy a strong enough boost, at least according to the IMF. The International Monetary Fund has trimmed its 2019 growth forecast for China as weak demand at home continued to take a toll on the world's second largest economy. While Beijing has sent warnings to businesses against debt-fueled expansion, the IMF said soft business confidence and growing tension between the US and China on technology was also a major drag on the global economy. Still with us is Carrie, Natixis Economist for Asia Pacific. Carrie, now, well, some would see this as a good news, obviously, because the US and China, they are finally thinking about, writing out a micro deal, some would describe, but then one would always confuse progress with movement. So this time, what is it? Is it just movement or is it real progress?
Well, I think it may be a bit of both, but probably a progress within a very short movement, simply because that I think at this point of the time that we do not still expect a full-fledged deal anytime this year or maybe next year. But however, I think at this point of the time that I think both China and the US actually may have the incentive to actually have this micro deal, especially that if we look at from the US in the past, Trump has repeatedly mentioned that he only wants one big deal and that's it. But however, this time the change is really that we see that he's willing to, I mean, no matter due to whatever different pressure, incentive that he may has, I mean, domestically, especially with some of the troubles that he is facing right now, I mean, in terms of different, the political environment. But however, I mean, for the US right now, maybe it's a time that they may want a micro deal, even though it doesn't cover every, I mean, single prospect that, I mean, that both sides actually want to mention. But however, I mean, if we look at this micro deal, we need to realize that a lot of details are still not released yet. I mean, we have a deadline that they want to reach, I mean, something that is more solid by the I mean by mid-November, that before the two leaders actually may have the chance to meet in Chile. But however, I mean before that, I think we're likely to see more, let's say, movement or negotiation between different, I mean the purchases of different agricultural products, or even, I mean, it's mentioned that the yuan may be part of the deal, but we haven't really seen any real details on that yet.
As you just described, this is it's not seen as a full deal, which, many economists out there are also saying the same thing. So, but even if like a micro deal, a temporary deal is signed, like what kind of implication does it have on the Chinese currency in the near term?
I think in terms of the currency, obviously in terms of the short-term prospect, right? I mean, if we look at the last year or maybe 2 years, the yuan has been repeatedly quite, sensitive to the negotiation of the trade talks. So, especially before it broke 7, when there is any optimism in the trade talks, it can actually go, surge quite a lot, and vice versa for the other way around. So I think right now we are likely to see the same trend that the progress of the trade talk is likely to dictate the change of the yuan. But however, even though we did see quite not a massive run, but at least like quite big appreciation of the yuan after the optimism of the trade talks actually renewed. But we need to be careful, or actually remember the risk that if there is any breakdown of the trade talks between the US and China, the yuan is likely to depreciate further. First, because of the market sentiment that people expect a worsening prospect, and second is that a controlled depreciation a little bit further may be able to offset part of the tariff. So I think going forward, the yuan is likely to have like a widening trading band. So it's still quite difficult for people to bet on a specific number, but to embrace a higher volatility.
Yeah, this week we also saw some of the economic data out of China in September. It wasn't really painting a very positive picture about the Chinese economy. But then one of the sectors that I do want to highlight is the Chinese real estate sector, because it is arguably one of the most debt-heavy sectors in China. And then usually that, the sector would go to Hong Kong. Hong Kong is one of its major funding sources. But now that uncertainties are hitting the city, which is its major funding source, like what kind of implication does it have to the Chinese real estate sector? Like, is it a gloomy picture ahead for the sector?
I think I think we can look at it from a different, a few aspects. I think on the revenue side that, of course, there's tighter restrictions on the onshore market that the government wants to control the increase in home price, and there's no question about it. Because if we look at the, let's say, the loan prime rate, which this mechanism is that the Chinese government actually renewed this mechanism, back 2 months ago to actually to provide a better benchmark of the funding costs. And usually the 5-year one is the benchmark for the real estate mortgages, and that has never changed. So I think for the revenue side, that we are quite sure that there is it's quite unlikely there will be a massive change in actually the policy in terms of reversion in supporting or actually encouraging a massive home price increase. So the question or the risk is really on the funding side, as you mentioned. So real estate is actually one of the sector that is most reliant on Hong Kong for financing, no matter for equity or even for bond financing, of which especially in the space of the high yield bond. So I think going forward, if there is the onshore operating market continues to be quite tightened, and then in the offshore market, if there is any sentiment that people do not want to invest in part of the real estate bonds, there could be higher risk associated that whether there may be liquidity issue, whether there will be a repayment issue, especially given the recent depreciation of the yuan, that they may need a higher portion of their revenue to actually repay those debt offshore, because those are denominated in the USD. So I think for that there is risk in the real estate, all these real estate firms definitely. So if there is further tightening, especially in terms of the capital, movement in Hong Kong, that there is a retraction of the capital actually invested in these companies. I think that we see a higher or tightening risk in that.
So, but then, say Hong Kong might not be one of the strongest funding sources for the China real estate in the near term. So, where else can the Chinese real estate look at in terms of seeking funding?
I think for now it seems to be quite difficult because there's a few funding sources of these real estate firms. For example, first that is that they can accelerate the down payment, which they have already did, and then simply because that in the past a large part of the actually funding actually comes from loans as well, especially from banks. But however, after the policy change that they do not want to increase the leverage of these firms anymore, it's now actually quite difficult for these firms to actually get the funding from banks. And after that, there's actually a switch to non-bank FI. But now, because of the shadow banking crackdown and different policies, it's getting more difficult as well. That's why a lot of time that we actually see that they try to increase the portion of, no matter for lending or even the bond financing from Hong Kong. So I think compared to some of the other sectors is that, I mean, for ICT or even for consumer, they do have a high reliance on the US. But for real estate firms, it seems that Hong Kong is still the most favorable destination or the source that they actually get capital or rich investors, simply because that it could be due to the fact that people are more familiar with these names, and in the US it may be a different story, or let alone Europe. So I think it's quite difficult for them to seek new ways of getting, especially global capital beyond Hong Kong. So I think right now that seems to be the continuous trend that they are going to do if they actually cannot access enough liquidity onshore, and then I mean Hong Kong seems to be still the most favorable place for that.
Yeah, of course, Beijing has also warned of the risks of debt-fueled expansion for different sectors in China, not just the Chinese real estate, but obviously the PBOC they have been pumping liquidity into the financial system. So is this a sign that the Chinese central bank is running out of tools to try to prop up the Chinese economy? So meanwhile they're warning of the risks of having debt, but then they are still pumping liquidity. So what is this telling us?
I think one of the key thing or key change that the PBOC has, I mean, in recent years versus the past is really about the the awareness on financial risk. That's why we actually see, on the one hand, there is more liquidity pumped into the economy, or at least, or whether it's in the real economy is subject to question because there's still a bottleneck on that. But at least they are trying to inject liquidity into the system. But however, compared to the past, it seems that the scale is still I wouldn't say limited, but actually less, compared to, let's say, 2008 and different, in the past era. So I think one of the key is that, the financial risk or leverage has become increasingly a concern. And right now, the key of the policy is really to solve this bottleneck so that this liquidity, which is less than a few years ago, can be really channeled into the real economy. That's why we see the reform on the non-prime rate, that they try to bring the interest rate down without injecting more liquidity. And also different MLF seems to be continued at a steady pace as well. So I think going forward, this is likely to be the continuous trend that the PBOC will try to make use of the liquidity which has been put in the market already through the LPR ratio, interest rate, and also through potentially more RR cuts as well. So I think these two tools is likely to be used by the PBOC. But of course, we also see different signs that this stimulus are not really getting into the real economy, especially if we look at, let's say, the local government special bond issuance. It has been really huge, but we haven't really seen a pickup in the infrastructure investment, as an example. So I think monetary policy is there, but the Chinese economy also needs a more solid fiscal policy in terms of, a real support for the ongoing growth.
Carrie, thank you so much for your analysis. That was Carrie, Natixis economist for Asia Pacific. This is it for this edition of All About Money. We'll be back right here on HKIBC next Sunday. Good night.